You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is real estate investment expert Craig Berger. Craig is the founder and CEO of Avid Realty Partners, a commercial realty firm focused on hotel and multifamily apartment assets. Craig is the senior project sponsor and has primary operating responsibility for the assets in Avid Realty Partners portfolio, including multifamily apartment buildings, hotels, new developments underway in Colorado, and other assets. Craig leads all property sourcing, underwriting, capital fundraising, and helps identify and implement operational improvements. Now, prior to scaling this commercial realty business, Craig spent more than a decade as a top sell-side semiconductor equity research analyst, including as a managing director for FBR Capital Markets and at Smith Barney Citigroup. And so I'm looking forward to peeling back the layer of Craig's business with the hopes that we can uncover some of the secret ingredients that have basically attributed to Avid's high level of success amongst the numerous commercial asset classes he and his team operate. Now, very quickly, before we get on to the show with Craig, I just want to run through a few laundry list items with you guys. First and foremost, this is something I tend to forget to mention most of the time, but just so you know, we're in deal acquisition mode here at Sunrise Capital Investors. In fact, we always are in deal acquisition mode. And the reason I make mention of this is because we're looking for opportunities to pay huge finder's fees for deals, for good opportunities. And so if you're out there on the hunt yourself, or if you come across something that seems interesting, yet you don't have the ability to take it down, please think of us. We've paid multiple finder's fees out over the past few years, and we'd love to put some money in your hand for a good opportunity. Additionally, we can come into a deal as a capital or operational partner, or both, if you have a lead on something that maybe you'd like to try to take down, but you just can't seem to do it on your own. Please reach out to us via our website. You can go to the Contact Us page at sunrisecapitalinvestors.com and just drop us a line, and we'll reach back out to you. Also, this might be a perfect way for you to get into the business, all while working with a group that has a strong track record like we do. Next up, we just opened up our second tranche in our mobile home park growth and income fund. And so if you're an accredited investor and you're interested in partnering with us on our own acquisitions, please visit our secure investor portal by going to invest.sunrisecapitalinvestors.com. You can find our PPM there and also our overall investment summary. You can download all our information. It's on a secure website. And lastly, guys, if you happen to be in the Tampa Bay area, I'd love to connect with you during your visit. Again, you can reach out to us through our website, sunrisecapitalinvestors.com. Just submit a message and I'll get back to you. And one cool thing is that if you make the trek and come visit us at our office, which is located in Safety Harbor, Florida, which is only about 20 minutes away from the Tampa International Airport. We're on the other side of the bay. I'll personally treat you to a tour of the Jacobson manufactured home plant that is literally one block away from our office. So it's kind of cool that we literally can get to see where the sausages are made right down the road from our office. So if you've never seen a mobile home being made from basically the frame up, you come visit us at our office here at Sunrise, and I'll treat you to lunch and take you down the road here and show you how mobile homes are made again from the frame up. Now, guys, without further ado, I'd like to welcome Craig Berger to the show. Craig, how you doing today, my friend?
I'm doing well, Kevin. Thanks for having me.
Yeah, thanks for joining us here. And I appreciate you taking time out of your busy day to jump on the horn here and talk about you and your business, man. So, I guess I gave you the very brief introduction, short biography of Craig Berger, but I know that's not the extent of it. So maybe take a few minutes, Craig. I'm going to pass the mic back to you and really let you fill our listeners in with, who you are and what your background looks like.
Okay, excellent. And again, thanks so much for having me on the show today. As you mentioned, I spent over a decade on Wall Street as a sell-side equities analyst, and that was great, but that business has changed. The opportunities as many today as they used to be, and I didn't feel passionate about that business the way I used to. And so as I approached my 40th birthday, I decided to pivot to real estate. I've been doing some fix and flips and smaller rental properties on the side for a few years, and sort of my real estate knowledge and passion grew and my Wall Street compensation shrank, I decided to cross over and take a chance and try to grow this business. And so, really I wanted to do great things for my investors, and I also wanted to do great things for my customers and the people at our properties. And so I felt I could contribute more to the world owning properties and delivering for those various groups of stakeholders than I could writing research and analyzing stocks, which I felt was more of a commodity product at this point in time. So that's a little bit of background on where I came from and sort of how I decided to get into real estate and pivot from Wall Street.
Okay, fantastic. I appreciate that insight. And, let's talk about what that transition really looked like. So, happy birthday to you, right? 40 years old, you're making a huge pivotal change in your life at that point. But what did what did the transition really look like? You were doing some side projects, some small fix and flips, small investments, but nothing, it doesn't sound like substantial enough to truly replace maybe the income and lifestyle that you had in your professional career. And so you guys scaled pretty quickly. You really had a much bigger vision. Tell me about that vision and how you basically made it happen.
Wow. It was not an easy transition. It's still not an easy transition. But really, I got started by buying a 95-unit multifamily on an auction site, largely with my own cash. And I sort of dove in. I didn't know much other than what I'd read online, but I knew I was buying a lot of bricks and sticks for the money. And we paid about $13,000 a unit.
Wow.
The property was full. It was about $20 a foot. And I figured hopefully if I blocked and tackled and executed, I wouldn't turn up upside down. And it's worked out well. We've actually refinanced into a Fannie Mae mortgage on that first property about a year ago. We tripled our equity in 3.5 years. And it's about a 40-something IRR. So it was mostly my money, a little bit of friends and family money. And that was how we got our start. And then it's on to the next project and just continue to identify value and try to make the right decisions.
So that was back in 2015. Is that the timeline that we're talking about here?
Exactly.
Okay, so back in in 15, there was still some distress. It sounds like I don't know really the story behind this particular multifamily asset, but $13,000 a door is no matter where you're buying, at least for the most part. I mean, if it's in the middle of the ghetto, then maybe not. But $13,000 a door, $20 a foot, well below replacement cost. Sounds like a great value. Today, that's a little harder to find, I would say. Or maybe you'll school me here and tell me that that's not the case. That you guys you're turning stones and you're finding those types of opportunities. So I guess where I'm going with that is talk about how your business has evolved since that point in time. So that was a great foundation that you were able to lay. I love those types of deals, and I'm looking forward to the days when there's more opportunities like that coming back. Based on how I think some folks are buying nowadays, I think in the next 5 to 7 years, I think there will be some opportunities circling back around that ultimately didn't meet projections or they weren't executed precisely. But we'll find out right in due time. But with that, let's talk about the evolution of Avid Realty Partners and how you went from that one multifamily property and truly took it from a one-man show, buying one 95-unit apartment complex on an auction site to a company, right? Two different things here that we're talking about. It's no longer really a hobby. You've built yourself a company.
So yeah, I mean, you're right. It is harder to find those deals today. I mean, that building is in a lower income demographic location. So it certainly has its challenges, but it's mostly running itself. We have a great staff on site, and we sort of got our legs under us on that one, made good progress, and then went out searching for the next one. I certainly wish I was a lot more aggressive in 2015 because prices have gone up since 14, 15, even 16. And I think you're right. People are largely overpaying now, predicated on a continuation of aggressive rent growth, and I think some of that rent growth is going to be harder to achieve in coming years. So we're being careful about the prices we pay. But, I went on to the next asset. I linked up with a guy who's a very talented hotelier. He's been a hotel guy for 25 years. And he said, hey, why don't, here's a good opportunity. We looked at a bunch of opportunities. I picked one that was bite sized that I could swallow, and I sort of jumped into the next project.
And so that was a hotel. The next project was a hotel.
Yes.
Okay, let's talk about that.
It's about.
We're going to duck and weave here a little bit, just FYI, because you got a good bit going on. So again, I want to get the entirety of the background of how really you got your foothold in the space. And so hotels, for the folks that are listening that aren't familiar with that asset class and may have never owned a hotel, I have not. But the one thing I do know, and this is not firsthand experience, it's just really secondhand knowledge being passed on from other folks, that hotels typically do great when the economy's strong and people are traveling, going on vacation, and lots of business travel is happening where lots of corporations are freely spending credit, sending their executives all around the country. But when there's a contraction in the economy, hotels typically take a little bit of a hit. And so generally speaking, sometimes it's considered a little bit more of a volatile commercial asset class. And what would you say to that?
I'd say you're 100% accurate. I'm not buying hotels as much right now because we are so far into the economic expansion. Mm-hmm. But typically in hotels, you're going to see 10 caps, 9 caps. Obviously, the higher the quality of the product, the lower the cap rate, just like in a market. So a really good, Marriott flag in a great market might be a 7 or an 8 cap, but that's kind of the bottom of hotels. And that's because banks typically will only go up to 65 loan to cost on a hotel. Sometimes it might even be less than that. It might be 60. So you've got more equity. You've got a lower mortgage. You've got more debt service coverage ratio from the banks, usually 1.35 or 1.4. So they're trying to bake in some of the cyclicality, protection against the cyclicality that you're talking about. But you're absolutely right. I mean, when the economy drops, discretionary business travel goes away, vacation travel goes down quite a bit. And so those are risks. On the other hand, hotels, you talk about value add and multifamily. In hotels, you can really do value add. You can find that Best Western and upgrade it to a DoubleTree where your rate just went from $99 a night to $139 a night. And you get that 40% bump in rate right out of the gate instead of over a period of 6, 7, 8 years. And so it sort of cuts both ways. But, there's a few players out there in the hotel space. It's a less efficient market. It's harder to sell a hotel asset than it is a multifamily asset, right? In Dallas, you've got 30 REITs and other institutional buyers bidding on every 300 unit property, whereas in hotels, you might have 2 or 3 or 4 potential buyers. And so as a buyer, you can negotiate your price a lot more aggressively. Don't bid against yourself in hotels the way people do sometimes in multifamily because it's a much more thinly traded market. So there's, risks and there's opportunities.
How does someone like in today's market, I don't know when the most recent acquisition in the hotel space was for you guys, but how do you hedge those risks? I mean, at this point in time, during the economic cycle, how does one really hedge against the risk associated, the general ones that are associated with the hotel space?
So as a former equities analyst, I look at cycles. In the past, I get as much STAR data, that's the company that tracks all the hotel revenues. I get as much data as I can from that hotel. I try to see how much was the peak to trough revenue decline from 07 or 08 to 09 or 10. And, often I can't get data that far back, but sometimes you can. I've studied a bunch of different hotels and that revenue drop can be 30 to 40%. So, obviously we run our downside scenarios and say, hey, if we lose revenues 30%, how long will our cash last before we're in trouble? And if revenues, drop 20%, how long does our cash last before we're in trouble? On the other hand, what's the upside to rebranding or reflagging or improving operations or pushing rate or pulling on some of the other operational levers that are available to us with the property?
Is there an opportunity? The only reason this even comes up, and I don't want to go off the rails here of the conversation. I was recently at a mastermind, probably about 40 other investors from different asset classes, and there was a guy there. He's mostly a multifamily guy, so in the traditional sense. But he recently successfully in the last year and a half converted, I believe, what was somewhere in the 60 to 80 unit range, a hotel right off an exit, and I forget what market it was in, but it was highly trafficked road, great exposure, obviously more of a commercial location, but he converted it into a multifamily property and literally maintains a very, very high occupancy and picked it up for next to nothing. It was a struggling hotel. I forget what the average occupancy rate was there, but it was low. It just was being mismanaged severely. And in any event, is there an opportunity in that type of conversion? Have you seen any guys be incredibly successful with converting from traditional hotel to a multifamily style property?
I've seen some of that, and usually it's with the exterior corridor hotels. That's kind of the motel or exterior corridor hotel. That's kind of the old style. So the resale value of those properties continues to decline. Mm-hmm. Right, Marriott and Hilton, they're not gonna do those. So you're seeing them as red roofs, and you're seeing them as Super 8s or value in or Motel 6s. And still the expense structure associated with hotels can be high, manning the front desk. Sometimes you have to give away breakfast. You might be paying 12 to 15% of revenues off the top to the hotel franchisor, the flag. And so when you take all that stuff away, sure, it could potentially be much more profitable to push into multifamily, right? You're getting into that, 45 to 50% net margin kind of business with multifamily. Mm-hmm. So, like you said, if you can't give it away as an exterior corridor hotel or motel, then sometimes it could make sense to convert.
Yeah. Got it. So you guys you're still bullish on multifamily. You already had made a mention that they're becoming harder and harder to find decent opportunities that really pencil out. What are you guys doing? I mean, what are some of the out of the box strategies that you guys might be putting in place to still fill the pipeline with opportunities to evaluate? Anything creative to speak of?
I need to get more creative to keep buying at today's prices.
Yeah.
I'm still a long-term believer in multifamily. More people are renting. The baby boomers are getting older. A lot of people don't want to own anymore. So the underlying trends and demographics still are very favorably for the multifamily sector, but the prices continue to make me nervous. That's probably been the case for a couple of years, and I've probably been overly conservative, and I've probably left some opportunities on the table. And so, you're never going to always get it perfect. But what I'm seeing right now is, properties in, let's just say, Dallas that 8 years ago were getting $600 a month. Now they're getting $1,000 or $1,100 a month. To make the deal pencil out, you got to assume that you're going to be able to get $1,500 a month in the next 5 years. And I think it's a pretty tough pill to swallow to ask workforce housing type of residents to grow from 500 or 600 8 years ago to 15 or 1,600 in another 5 or 6 years. I just don't think there's that much economics with some of these tenants, and sometimes that's what it's taking to get these deals to pencil. I go to CrowdStreet and I'm like, oh, I bid on that property and I bid on this one, and what did the buyers pay and what did I have in my model? And I go back and do a little post-mortem on some of these deals, and it literally blows my mind. So I don't always get it, but I guess that's just the way it goes. Other people might have more faith in rental growth than I have. In terms of what I'm doing to get creative, it's a numbers game. I bid on a lot of properties at a price that I'm comfortable with. Mm-hmm. I try to nurture broker relationships for key cities that are interesting to me and ask those brokers for their assistance. And sometimes that works and sometimes it doesn't. Occasionally I get an early look at some of these deals from brokers that I have a good relationship with before they're on market or before they're widely marketed to the 40,000 person email list.
Right.
And then, also if you know sellers and you have relationships with sellers, then you can, it's always good to ask them if they're selling. But those relationships, take time to bear fruit.
Yeah. What are some of the markets that you guys are bullish on today? And you mentioned Texas a few different times. Is that primarily where you're spending your time and energies in the multifamily space?
Well, we bought a 235-unit apartment property in Houston about a year ago, coming up on a year ago. That's done well. We sort of bought at early 2017 prices, and I didn't close till early 2018, and we've continued to push rents. So that's been pretty good so far. Dallas is a very expensive market right now. I'd love to own in Dallas. The job growth has been incredible. My strategy is follow the job growth, follow the population growth. So it's the cities that you're going to hear most often for people that are chasing growth. It's, Dallas and Houston and Austin. It's Tampa and Orlando. It's Charlotte and Raleigh. It's Phoenix, maybe Denver. Some of those cities are a little harder to buy in and pencil out than others. Like the Austins and the Phoenixes are just super hard to pencil.
Yeah.
So I guess I'm more focused on, Orlando and Tampa and Houston, maybe San Antonio, for places that are still growing, but I can still make the numbers pencil.
Okay.
Not easy right now, man.
Yeah, I know it's not. That's why we're talking about it. We're trying to find out what you might know that we can share with the world and give away all your secrets, right? Now, I want to talk about this business is challenging, right? Scaling a company, you've got to look at, a certain number of deals to find something that ultimately fits your model. And even when it does fit your model, there's still challenges that exist that weren't really in your initial projection. Things come up, right? It's the life of an entrepreneur. I don't care if you're buying real estate or you're in, any other type of business. Challenges come up that are unexpected. You have to work through them. Let's talk about maybe, this doesn't go back very far. Obviously, you just made your transition into this side a few years back, but have there been any deals that haven't gone as planned? And if so, can you speak to them?
Well, no deal is going to go exactly as planned, and it's always sexier before you buy it, and then you own it, and you're dealing with the crap. So, that's part of anything. I think the best day of a boat owner's lives is the day he buys his boat and the day he sells his boat. Real estate kind of the same way, but we were working on a new development project. It's a great project. We had great partners. Our co-partners in that project really wanted to own it. And they presented me with an exit that made sense for me. So I thought we were going to be writing that project further, but we had an opportunity to exit with a positive outcome, and our joint venture partners really wanted that deal. So that's an example of circumstances that changed and my desire to manage risk. And so that one didn't go exactly as I foresaw, but still a good outcome.
Was that in your bio? I'd mentioned some projects you guys are working on in Colorado. Is that what you're speaking to? Maybe a project in Colorado, or is this something completely different?
It is located in Colorado. I have a few projects there. That's one of them.
Okay.
So it's just about assessing conditions on the ground and playing them as they come. To your point, growing a business requires capital. It requires exits. It requires track record. And so all of those things are important.
What are some of the other projects other than hotel or multifamily that you guys are involved in, or is that it at this point in time?
So that's really it at this point in time. I'm starting to look more at single tenant net lease or either triple net or double net. I've been looking at some CVS Walgreens opportunities. I've been looking at some office building net lease opportunities. And that's just because if I can get a 10 cash on cash return with a high level of certainty and a low level of expenses and deliver that cash flow to my investors with some potential appreciation story down the road, at this point of the economic cycle, I view that as being a risk mitigating strategy, right? I still want to grow. I still want to deliver returns for my investors. But if I can, buy an office building that has 7 years left on the lease and a couple 5-year extension options with a credit grade tenant, and that gets me a 10 or a 10.5, and there's very little management work, why do I want to risk overpaying on some multifamily in Texas, do a whole bunch of work and bang my head against the wall to try to deliver a 6 or 7 or 8, or if the economy goes south, maybe less than that for a couple of years. So I'm starting to look there because that's what the market is kind of telling me to do, or that's what that voice inside my head is telling me to do in terms of risk management. Got
it. So let's talk about the multifamily space and, some folks out there overpaying. I mean, being an analyst coming from that background, I'm sure you sit there and as you mentioned, you look on CrowdStrike, you see deals that maybe you had taken a stab at, and ultimately you're looking at what someone else paid for it, which is significantly more than what your highest and best would have been. You run these probability scenarios of what that might look like in the long run for that buyer that ultimately did pay, $1 million or 2 or 3 more than what your highest and best was. What do you think is really going to play out? I mean, I think there is There's a certain side of it that there always are going to be better operators out there that might know a little bit more than you and I, that might be able to run a more efficient business than you or I could, that can overpay or might have a lower cost of capital. A lot of different scenarios out there of how they still might be successful with some of these high-priced assets. But what do you think, just generally speaking, do you think there's going to be some defaults coming back around, in the next 5 to 7 years with some of these assets that are being, basically overpaid for?
I do. I think there's definitely a lot of less experienced people that are buying assets that are sort of in a frenzy right now. I mean, you've had a lot of educational guys out there like Dave Liddell or Brad Sumrock or Lifestyles. And, you've got a very large student buyer community that's out chasing deals with sponsors backing them or co-signing the mortgage with, I think that kind of makes me a little nervous for the prices that I'm seeing some of these assets trade at. You certainly bring up a good point. A lot of the institutions that are buying could and probably do have a lower cost of capital than what I want to deliver. So, I try to deliver a 15 IRR over 6 years. That's about a 2.2 times equity multiplier at the project level. And I try to have a realistic exit cap rate, probably higher than today when I bake into my model. But possibly some of the REITs have, less aggressive hurdles or more aggressive cap rate exit assumptions or more aggressive rental growth rate assumptions. I think those are kind of the key variables. And you're right, if somebody lives in Tampa and knows that market inside and out and is only focused on Tampa and knows the path of progress, they could be willing to make bets over the longer term that, I wouldn't see from Manhattan, or I wouldn't be willing to bet your money on.
Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I'd like to leave with one last thought.
From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show.
Property management side of the business, the first 95 unit you had purchased, you had mentioned that it's, I don't know what you would classify it as, maybe a C+ class, B-. I'm not sure exactly where it falls, but you did mention a little bit more of a challenging
C-.
Okay, a little bit more of a challenging demographic. More of a blue collar worker base, just a little bit harder to collect from. Just folks that work at factories or make minimum wage. Dual working households. But generally speaking, the property management side of it, let's talk about that a little bit. I'm assuming you don't manage the properties yourself. Maybe you do. I shouldn't make assumptions, right? Let's talk about who handles the property management. Do you outsource it or do you handle it in-house? Do you have your own team?
So I've done both and I still do both.
Okay.
I just bought a 75 unit 3 weeks ago in St. Louis. We're self-managing that because I don't think I can get a good management team for the money that I'd want to pay. And I'd probably end up doing it all myself anyways. Mm-hmm. So I do have a local partner on the ground in St. Louis who's able to be there and show up and help us take care of some of the upfront work that goes into fixing any property. The 95 unit, we actually self-managed, sort of same thing. I just wanted to be super hands-on and deal with it myself. Mm-hmm. The larger properties where you have a little more rent, I think it can make sense to use a third-party management company. Absolutely. Obviously, we pay them well for the tremendous work that they do. And I still do a lot of asset management. I still do a lot of touching base, making sure that the management company is being as effective as they can be, and that I'm applying the right amount of pressure to get results. Mm-hmm. And that means not too much pressure and not too little pressure, but making sure that we've outlined the strategy, the annual budget broken down by month, and that there's accountability to all of those trends. So whether you're doing it yourself or have a third-party team, obviously it's easier with a third-party team. You do less work, but I also don't control it. And I work through an intermediary, and they may spend money in a different way than I would spend money. And so it's easier with the third party team, but it's also harder because you don't directly control your outcomes there.
So with like the 75 unit that you just purchased, is the plan basically to get it stabilized, do any of the improvements that you're looking to make to it, and then once it's running smoothly, or as smooth as possibly is going to be, hand it off to a third party manager at that point, or do you think you'll keep that one in house?
I think our plan is really just to staff it up as well as we can, probably pay a little bit more to hire better people and continue to do it in-house and empower these staff members to run it as if it's their property. Of course, we're still checking in several times a week. Again, my co-partner on that property is there and local and can be there. But really, we try to hire great probably than we have to hire good people and make those staff members feel like it's their project and not just my project, because it is their project. And they're going to have some profit sharing. They're going to have, if we refi or sell, they're going to get a piece of that. And so I sort of expect excellence, and that's kind of the plan. Really is all about the staff. The third party.
Go ahead. Sorry.
I was just going to say the third party team for a 75 unit, I'm still going to pay for all the staff. They're still going to hire the expensive contractors to come out and fix anything that my in-house staff can't deal with. They're still going to charge me for that kind of property, probably, 5 or 6% of revenues instead of 3 to 4. And I'm still going to be doing a bunch of the work. And I'd rather just do that one myself.
Yeah. Got it. What kind of staff does it take to run a property like that? Do you have one full-time or part-time on-site manager and then a full-time maintenance guy, or is it more than that?
That's the plan. This property is pretty good from a renovations and property condition standpoint. There was no full-time property manager on site when we bought it. So it was about half occupied and half vacant.
Wow.
The seller was a very elderly gentleman, no full-time staff, but his son worked at the property doing the maintenance and renovation. So that was really good. The quality of the apartments is good. And there's still, it's all about marketing and collecting rent and some of that operational stuff. So our plan is one in and one out for that property, which is more than we would be spending if it was 100. We'd still try to do the same, or maybe we do, if it was 100 units, one in and 1.5 to 2 out. But, 1 and 1 is about, roughly 80,000 of salary plus some benefits plus overhead. You're talking about 110,000 a year. It's a little more than what our benchmark is, but we paid a low price for that property, so we still think it's worth it.
Yeah. So 50% occupied. That's a fairly aggressive lease up that you'll have to do in that property. I'm assuming that did not qualify for any type of agency debt today. So is that a bridge loan that you got on that property? What kind of debt were you able to put on that initially?
We went to a community bank that I have a relationship with, local in St. Louis, that I've worked with before on a smaller deal. Have a relationship there. They gave us basically a 5.6% interest rate, which is a little higher than the agency right now. Although in the small business SBL side or small balance, it's not that much higher. But this bank gave us no prepayment and a 0.25 point into the loan. So low fees, no prepayment, and 5-year term. And if we want to re-up with them, great. If we want to stabilize, get the income up, and go to Fannie Freddie in 2 or 3 years, we can do that.
Yeah. So what is a long-term play? Let's talk about that property, and then we can move on. So do you mind sharing what you paid for it? I mean, now that you're closed, and just give us an idea of what your going in per door was, and then what you expect to be the back end in 3 years once you're fully stabilized.
So we paid $22,000 a unit. There is, which I think is super attractive. They're 800 feet. They're in good shape, mid-80s garden style apartments. You don't find $22,000 a unit in Dallas or even Houston anymore. You got to go to some of these more niche locations. I mean, St. Louis is still a huge city. It's my original hometown. It's how I know it. A broker knows that I own in that general vicinity. He gave me a call before he listed it to his 40,000 email recipients. And so it was sort of pre-market, and I jumped on it. The plan there, and there's a property for sale right now listed by Bercadia, less than a mile away. It's 10 times the unit count, so much more institutional asset. It's been fully redone, and it has the pool and the clubhouse and all the amenities, which my property doesn't have as much of, being only 75 units. But their whisper on that property, on the bigger one, is 40 a door right now. So that would be a goal for me over time.
Got it. Fantastic. And what are the average rents in these units here, of the 75 unit? 600 range?
650 plus 25 for water, sewer, trash. That's kind of the play today. I think market on the 2 bedrooms in the submarket's about 710. So we're slightly below the submarket average, but within range. It's really not a push the rent play right out of the gate. It's a get full and collect. I generally demand that my tenants pay by the 15th of the month. And if there's a reason why they can't, and we have a relationship and they have a plan to pay and pay next month, and there's a plan and an agreement and they stick to it, I'll work with people. But otherwise I just send them the legal straight out, because, I have to pay my mortgage. Everybody has to pay their bills.
Absolutely.
That's how it works.
Yep. And so what was the actual normalized cap rate that you guys acquired that at? It sounds pretty healthy.
I don't know what the cap rate is, because they didn't really, they were missing half the salary and they're missing half the rent.
Well, just normalized based on, what your projections look like for the first 12 months. That's what I was trying to get at. Just if you could ballpark it.
We think we're going to get it to an 8 to 9 pretty soon.
Okay. Got it. Well, fantastic. Yeah, that's exciting. That's good. That's congratulations. I'm going to clap my hands for it.
Thank you so much.
You just got to do about 10 or 20 more of those. That's all.
That's the problem. It's smaller than what I, really want to deploy. But when it's hard to find a value and you want to work, then you take them as they come. I mean, you can do the math on 22,000 a unit on 75 units and know that there's not, I'm not retiring on this deal.
Yeah.
Right. But it's another brick in the wall. It's another opportunity to demonstrate track record and execution and deliver for my investors and deliver a better experience for my customers. And again, if I do well, my personal economics over 4 or 5 years should be enough that it's worth doing.
Yeah. I know a lot of multifamily guys, and I really think that there's in these niche markets, like you mentioned, St. Louis maybe being one of them. There's many others out there. I do think, I know there's inefficiencies with a project of that size. I get it. It's not as attractive as just knocking down 350 unit at a time. It's surely not. But I do think that there's a sweet spot there. And I think with the right systems in place, there's opportunity there. They can be, you'll find quite often, or at least more often, older aging owners, mom and pop style owners. Makes it a little bit harder to buy because their financials are a complete disaster. So getting clean books, is slim to none. That's going to happen. But I think that there's an opportunity in that space in a lot of different markets out there. So just my personal opinion based on feedback that I'm hearing out there. But again, it's not as sexy as taking down a 3 or 4 or 500 or greater, institutional type, multifamily property. But then again, you're also not buying it at a 5 cap. So with little room to run.
Yeah. I mean, it's a tweener in size. And, frankly, it's just as much work as the ones that are 10 times the capital or even 20 times the capital, because, when you're buying higher quality at, 110,000 a door and 400 units and you're really plopping down a lot of capital, you can actually afford to hire tremendous help, the best contractors, the best third-party management teams. So these little ones are as much or more work.
Sure.
But that, when that voice in the back of my head is saying, how are you going to make money on this $25 million deal? And how are you going to deliver for investors? I have to listen to that voice.
Yeah, no, I think that's a valid point. So I know that you really just made your pivotal move back in 2005 with buying that first property. And so it's only been, give or take 4 years. But if you could go back knowing what you know today and give yourself some advice, Craig, back in 2015, other than, you can't give me this answer, other than you would have bought more. So you can't use that as an answer to that question. So what other advice would you have given yourself 4 years ago?
So first of all, I'd say find some good mentors. That's always important. Find some talented people to work with that are willing to work with you. Maybe they don't have capital, or maybe they're not good at sourcing deals. Find some value that you can add. Somebody who has experience, leverage that person's strength. Maybe they know everything about Denver and you want to work in that growing market, but find good, trustworthy people that can add value to you and you can add value to them. The other thing I'd say is, if you want to be a commercial realty person, then find a deal that you think is good and go for it. There's no way other than to do something except to do it. And I'd say, if you're passionate about it, find your passion, find your inspiration, and reach for the stars. You got to go for it.
Boom. I love it. Now, we're going to enter in what I call the golden nugget segment. So I hope that wasn't your last golden nugget, because you got to come up with one more. That was really good, though. I love it. You really do have to get out there and take action. I mean, you mentioned all these different educational programs that are out there. While there's plenty of credible folks out there teaching it, plenty that are not. But, neither here nor there, learning, the theoretical side of, the business, whether you're going to buy apartments or mobile home parks like we buy, or hotels like your partner buys. It doesn't really matter, right? Unless you actually put it into action. You got to get out there and just know that you're going to make mistakes. It's going to happen. I don't care how much you know what your background is. You're still going to make mistakes. There's going to be things that occur that were not part of your projections. Things aren't going to exactly work out as planned. As you grow larger, as you evolve, as you gain more on the ground experience, hopefully those mistakes you might have made years prior, you'll know how to see them ahead of time and ultimately avoid them before they occur. But in any event, you're going to make mistakes. So no, I think that's great advice. And so, Craig, I'd like to enter to what I like to call the golden nugget segment of the show. And this is where we're going to round things out here for the day. So if you did have one final golden nugget of advice or wisdom that you could leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career? What would that one last gold nugget be?
Be willing to make mistakes, but certainly hope they're not fatal, right? Think about managing risk, really measure your downside. If the economy stops growing and shrinks, how long can you live? How much cash do you have? As part of that, when I did my first project, I barely had any extra cash on hand when I closed. And maybe that's because I was stretching with my first 95 unit and it was mostly self-financed, but have a lot of cash on hand at the project level for each project.
Yeah.
Have more than you think you need. Renovations cost more, right? The brokers are going to tell you it costs $4,500 to renovate a unit. And then, when you actually get real contractors in that are busy, it's 70% more than that. It's $7,500 a unit.
Yeah.
So have cash on hand, protect yourself, be willing to make mistakes, but hopefully not fatal ones, and make sure you're measuring the downside, the recession scenario, and how long you're going to be able to survive if business shrinks 5%, 10%, 15% from current levels. I'd say that's pretty important.
What would you suggest? So you've got an analyst background. I think that's one of the voids that a lot of folks that are just getting started, they might not have that same background and experience to be able to assess risk properly, like you do. I mean, from a scientific standpoint. What advice would you give those types of folks that they've got the drive, they got the hunger, they've got the wherewithal to uncover deals, to drive opportunity, to find opportunity, and to maybe even raise capital, but they don't have that expertise that you would bring to the table as far as the analyst background? What advice would you give those folks? Because I think that's a key part. I mean, that's a big piece of it. It's a huge piece of it.
Take some Excel classes. Try to get a basic model out for your revenues and expenses. Mm-hmm. If revenues shrink 10%, expenses don't. How much money are you making or not making? Kind of run that even at a basic level. Maybe you don't do it on Excel. Maybe you do it on a piece of paper. If you're not willing to get on the computer or take an Excel training class, but there are models out there on the internet. There's apartment Excel models. Get one, play with them. I spend a lot of time doing that. I've also trained team members. I have training videos on how to underwrite because I got tired of teaching people. So I just recorded, me doing 5 different deals for 5 hours and said, do each one of these 3 times yourself before you call me back.
Yeah.
And so, there's also, but I spend a lot of time on Excel. I spend a lot of time twisting and turning the knobs, trying to get a feel for what could go right or what could go wrong. And of course, looking for the right properties and the right locations and the right price versus rent level and all the things that are required to try to make this business work. It's a lot of hats.
Yeah, no, absolutely. And so my additional advice I would add on to the top of that would be for the folks that are out there that don't, look forward to becoming an Excel expert. Sometimes it's just not in everyone's DNA. You can buy the existing models that are out there that fit within your space, but to truly have the expertise you're still going to lack some of the expertise that obviously you would bring to the table, Craig, from your prior experience. But there's always someone else out there with that complementary skill set. It doesn't mean that you have to necessarily have the same exact skills, analyst skills and financial skills as Craig might, right? But there surely is another Craig out there, and that Craig could be a partner. It could be a consultant. It could be someone you could lean on. Maybe it's just for a fee, or again, find someone that maybe they don't have some of the skill sets you have, and that's finding deals and being outgoing and, sourcing opportunity, right? And kind of team yourself together. I can tell you that's what I've always done. I've never been the Excel guy. I run models. I run the initial models on all of our properties. I handle the acquisitions. But when you really dive into forward-looking analysts and how it's going to play into our fund structure and all, I mean, it's outside of my pay scale. And that's why we've got someone in-house that ultimately that's their expertise, right? I lean on their expertise, whereas they're not sourcing deals. They don't have that skill set. And so we work really well together.
You bring up a really excellent point, which is to really grow this business, there are so many hats. You have to lean on a lot of people.
Yeah.
And some of those for me are local people in each of the cities I'm targeting. Some of those are bankers or financial debt providers. Sometimes it's people on Upwork.com or Freelancer that might be not that much money and have strong analytics and can help you on that front. Or they might be marketing people or email scraping LinkedIn people. And there's a whole, there's a whole village out there. Upwork.com has been a great resource for me to find relatively inexpensive assistance for things that I'm not good at or don't have the time to do myself.
Yeah. No,
but also, it takes a village, find people to lean on.
Yep. No, that's great advice. Well, Craig, this has been a lot of fun. I really appreciate you joining us here today. And again, I know you're incredibly busy. And so taking the time out of your day, I'm incredibly grateful for that. So folks, if you'd like to learn more about Craig and his company and, some of the activities they have going on, you can go visit his website, which is avidrealtypartners.com. Again, avidrealtypartners.com. And I'll be sure to put that in the show notes also. Craig, that's all we have, my friend. I wish you the best, and I look forward to staying in touch with you. And just keep kicking butt, my friend.
Kevin, thank you so much. I appreciate it. Have a great day.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.